Welcome back to another video. Today we're talking about trading liquidity. So I've been excited to do a video about liquidity for quite some time. I love the concept of liquidity and I think it's really helpful for your trading overall. If you understand liquidity, you can begin using it in your trading. You're going to improve your entries and you're going to run into a lot less losses. And as well as this, you're just going to have a better understanding of how the market works. So what is liquidity? Well, the word liquidity directly refers to orders, the orders in a market. When I say orders, I'm talking about buy orders and sell orders, stop losses, sell limits, buy stops, sell stops, and so on. And how we actually use liquidity, or these orders within our trading, is to identify high probability areas that are likely to be pushed through, okay? So if we take a look at this trading range we have on the screen, this example, we have here a standard trading range. We have essentially equal highs there and equal lows here. So this is what's known as a consolidation. Now, in a consolidation phase, we generally build up liquidity either side of the range. Now, I'm going to run you through this and explain why that is. So there are many different types of trader who are trading within a range. Okay, we have obviously millions of market participants every single day, and many of them are placing very similar trades because many people are trading in a similar way. So first of all, we have buyers. Now, the buyers are generally going to be buying from support. These are obviously traders who have the idea that the market is likely to go up, be it to the top of the range or further. So they are buying at the bottom of the range at levels like this and this and this. So their stop losses are now situated underneath the trading range. On the flip side of that, we do have sellers. Now, the sellers are obviously looking the other way and they have a different bias to the buyers and they believe the market's going to go lower. Either they're just trading to the bottom of the range or they're looking to take extended targets down. So their stop losses are usually going to be over the highs. So the stop losses of the sellers look something like this. The stop losses of the buyers looks something like this. Now, what we also have are breakout traders. These are traders who have buy stop orders or will look to manually execute when the market breaks out. So the traders who use buy stop orders will have orders just above the trading range, and potentially the bearish breakout traders will have orders just below the range like this. So what this is actually more orders, okay? We have buy orders here, we have sell orders here. So we've got a lot of liquidity both ways. We have a lot of orders sitting here, be it stop losses or buy stops, and we have a lot of orders sitting here, whether it's stop losses or sell stops. So what does this liquidity mean? Well, how can this help us? Well, the way that we use liquidity and the way that liquidity can become very useful for us is by understanding how the market moves based on order flow. Markets move based on supply and demand, and they have real reasoning behind every single movement that happens in the market. Now, the trader just focusing on this range isn't thinking about the order flow and isn't thinking about the real reasons behind market movements. They're just thinking about this trading range, okay? They see, their basic retail patterns form. They've got a support floor, let's buy it. They have a resistance, let's sell it. This isn't a great way to look at the market due to the fact that there is logical reasoning behind every move in the market, and it does follow the flow of orders overall. So now we're going to take a look at this example here, which is a pattern that formulates a lot in the market and is actually just replicating something that we see in the real live markets. So let's assume we are in a downtrend. We have a lower high here, we have moved down, formed a lower low, and then we've come up and we've formed this trading range. Now, many traders who don't know how the market works and don't know that the market moves on order flow will be using this range to sell, okay? Thinking, right, we're in a downtrend, we'll sell. And we may even have, you'd be surprised, some people looking to buy the market from this point, okay? Potentially seeing this as a reversal or whatever. So what this tells us is we've got stops this side, we've got stop this side, we've got breakout trades this side, we have breakout trades this side. There are many very basic retail patterns and retail methods that you probably all know about or know somewhat of. And because everyone knows of these patterns, they're easy to identify in a market. So in this example, then we have our lower low, we have our lower high come in here. Normally at a lower high, we're going to have a supply zone. So here we have a supply zone plotted on the chart. And generally we know that if we do have a supply zone, before we continue the move in line with the market, we're going to come up and retest that supply zone like this. Okay, so this whole consolidation here generally is never going to be a good place to sell because the chances are we're going to push up and come through here. Now, why does this happen? Well, this is where liquidity really gets interesting. In the market, we have two types of participants. We have retail participants like me and you, individual independent traders trying to make a profit out of the market. We also have institutional participants, be it banks, trading firms, any of the institutional participants like that. And these guys trade massive orders. These institutional participants are trading multi-million or billion-dollar orders. So they want to execute massive orders in a market And sometimes they just cannot do that. Now, let's say that an institution now wants to sell. They see this market and they want to get in on the short side of this market, be it a trading firm or a large institution. They want to sell this market. Now, they want to execute, say, a few $100 million worth of short orders. Well, to do that, they need to free up more orders in the market. If you think about how a market works, if you're buying, you need someone to sell to you. If you're selling, you need someone to buy from you. If they're trying to put on a huge order of multi-million dollars, without the liquidity, without the free orders to actually allow them into the market with that order, they need to free more orders in the market. So how can they do that? Well, we know here that we do have stop losses. When a stop loss is hit, what this actually does is release orders into the market, right? Say you're a buyer and you have a load of orders here. When this is triggered into the market, you're going to sell those orders off back into the market for a loss. If you're a short seller and you're selling from this point, you're going to have to then rebuy those orders at a loss if your stop is hit. And what that actually does is free up all of those orders from sellers here, or on the flip side, all of the orders from buyers here, back into the market. So what institutional participants can do is put on a counter move of some significant size, because if we do get a large injection of volume or a large injection of orders into the market, that is going to drive price somewhat. And that's why we normally get those large moves in the market. And what they can do is put on a counter order of not quite the size they want, but a size large enough to actually give the market some movement, take out the liquidity, run through the stop losses there of all the sellers, free up all those orders into the market, and then that brings them into a high interest point to actually then sell the market. So we get to this point in the trading range. We have sellers this side, we have breakout traders, we have sellers this side and breakout traders. And what happens next is the market gets pushed through those stop loss orders and breakout traders, frees up all those orders into the market, where the institutional participants can then begin adding the sell orders on from this direction when they're in a prime location to do so. That is the basic concept of liquidity and how it works. Now, what does liquidity look like? Where are the main places we're going to find it in a market? The answer to that is probably your favorite chart patterns. If you're trading with basic retail chart patterns, you are most likely providing the liquidity to the market. So let's now take a look at some of the top retail patterns where liquidity shows itself. Double tops and double bottoms are one of the biggest. Now this includes double bottoms, double tops, triple bottoms, triple tops, and so on. Anywhere where equal lows form in the market or equal highs form in the market is a surefire location to find liquidity. Now you might see two equal lows form in a market and think that this is giving you a great place to buy from because it's showing you a clear support floor like this, or on the flip side, a clear resistance point to sell from. But indeed, this is going to be a prime place for liquidity. Now, if you've ever seen, which I'm sure you have if you trade these patterns, this kind of movement happen and you thought you were tricked by the market, you thought you feel cheated out of a trade because the market's come through your stop loss and then flew off in the right direction, the reason for that is liquidity, okay? We come through, we take the liquidity, we trigger these stops into the market to allow institutional participants to put on large orders, and then the market really begins because of that large injection of liquidity and that large injection of orders brought on by the institutional participants. So with double tops and double bottoms, it's very, very likely, and it happens very, very often, that we actually go and clear the double bottom or clear the double top with a spike that takes out stop losses and then flies in the right direction. Another very common location for liquidity to affect your setups is on triangle patterns. This goes for ascending triangles, descending triangles, wedge patterns, anything of this nature. Now, the textbook triangle pattern looks something like this, where we obviously come in and form the triangle lows and the equal highs, and then we break through the equal highs and make a bullish run to the upside. This is how most people look to trade triangles, but if you actually have been trading triangles, I'm sure more than once you will have seen a movement like this. And the reason that happens is, once again, liquidity. We have, of course, buyers looking to buy the breakout because that's how these triangle patterns work. So we have a bunch of buyers here. What we can actually do is activate their orders and then run them back through the stops, and this is going to free up so much liquidity for a large short move down. This happens very often. If you go back and look in past price data at triangle patterns and identify triangles, so many times are you going to see this kind of movement where they've been pushed through, triggering that entry formation, and then absolutely slam through the floor. Now, sometimes it will even do something even worse, come through the floor, and then move higher. Okay, the reason that this happens is obviously we take the liquidity here, we get this low run down. That's a lot of profit on the table already. And then obviously we see breaks of structure. We see traders seeing the bottom has now broke out. So they now look to sell this way. And instead they get burned once again, because what this has actually done is grab all the sellers in this area and then burst to the upside and take them out as well. So now you understand liquidity and the basic concepts of it. How does this actually benefit you? Well, there are three major reasons and three major ways that this is going to help your trading. First of all, you're going to run into way less losses than you would if you were trading with basic retail views and you didn't understand why liquidity was doing what it was doing. Second of all, you're going to get a real sense of why the market moves. If you understand liquidity, you understand why the market is doing these spikes, why it's running these stop loss hunts, so to speak, you're going to be a lot more confident in your trading. And third and finally, you're going to get pinpoint entries if you can use liquidity in line with other things. So let's quickly talk about each of these individual points. So for point number one, way less losses. The reason you're going to achieve way less losses now is because you understand where to not buy the market and where not to sell the market as well. So if we see in an uptrending move like this, we get a higher high, then we come down and form what could be a higher low, and we see a range form. You definitely would not want to buy the double or triple bottom here, even if it was on a breakout like this, because you know that we haven't really fulfilled any high interest zones, which is normally going to be supply and demand zones, and we do have the equal low liquidity sitting there as well. So you know now not to join the herd of buyers there and to actually wait for a real reasoning for entry, which is going to be a tap of supply and demand. Second reason of understanding how and why the market moves how it does. Now that you understand liquidity, when you see a breakout like this, followed by a big push down, taking out all these stops and all of the stops of the breakout traders, you're going to understand why that's happened. You're not going to be sitting there ripping your hair out thinking, why did I lose? Why did I lose? You're going to know why the market did this. So it's really, really good to boost your confidence and also give you better results just by understanding why the market moves. You're going to have a lot more clarity and confidence in your trading as well. And the third reason, pinpoint entries, is because you know where to buy or sell from now, and you obviously know where to not buy or sell from. So in an instance like this that we were just on about, when you see these equal lows form, instead of buying here with a tight stop and losing, or buying here with a wide stop, what you can actually do is understand that the market is going to drive through that liquidity, and you can instead look to enter from a pinpoint level, such as a demand zone in the uptrend or a supply zone in a downtrend. This is going to give you much better entries and allow you to get higher risk reward and a lot more winning trades as well. So here are a couple of pinpoint trades that I've taken myself and inside of my community, using the concepts of liquidity to allow us to find pinpoint entries. The first one was on GBP USD, a massive trade, and the second one was on gold, an equally great trade, using obviously, as you can see, the liquidity here and all of this space here that was left open to actually identify a good place to sell from. So those are just a couple of positions using the very same concepts of that liquidity and of the order flow, and using the real locations to buy and sell from. Obviously, as you can see in this example, we would have had sellers coming in at this level, probably sellers coming in here who were taken out with this move, and then even the sellers here were taken out by this final drive before the market moved in the right direction. Same again here, we can see many attempts at selling. We have selling here, we have selling here, we have selling here, a final attempt here, and then all of these equal highs and equal highs are pushed through to provide the real selling location where we can get a really pinpoint entry thanks to our understanding of liquidity along with other market flow concepts. So thank you for watching today's video. I hope you've learned a thing or two about liquidity and hope I've opened your eyes to a new perspective of the market. If you want to learn all about liquidity and see my step-by-step trading system that I use to take pinpoint trades week in and week out, head over to the link in the description and join my trading course. There's now over 11 hours of content in here, including everything you need to succeed. We have foundations for beginners, we talk about mindset, risk management, fundamentals, and then we go deep into technical trading. And after all of that is complete, there's even a planning section so that you can build your own winning trading plan. So if you're serious about your trading, head over there and enroll. The price is going up soon, but for the meantime, you can still get in at the current price. Thank you for watching, thank you for listening, and I'll see you in the next video.